Good afternoon. Welcome to Bank M&A is Now the Right Time. Today's conversation features speakers from Artisan Advisors, Hovde Group, and Waller Law. Today, we are going to explore the environment in 2021 for mergers and acquisitions in the community bank industry from the perspectives of three industry participants. From the managerial and operational perspective, Artisan Advisors; from the investment banking perspective, Hovde Group; and from the law and legal perspective, Waller Law. I'd like to introduce today our panelists. We have from Waller, Richard Hills and Wes Scott; from Hovde Group, Kirk Hovde and Jason Tremblay; and I'm Jim Atkins from Artisan Advisors. Before we get into today's agenda, a little housekeeping. We have a link to the event page and it's in the Q&A if you'd like to read any of our bios. We only have 60 minutes with you this afternoon, but we hope to take questions. Please submit any questions you have in the Q&A feature, and we will monitor those questions throughout the presentation and reserve a few minutes at the end of the webinar to answer your questions. And also finally, if anybody's noticed my face, this is an M&A seminar and not an MMA seminar. Sometimes it pays to read the fine print. So with that, let's go to some economic commentary. Recent data reflected that the economy gained momentum in March. Much of the momentum was due to the return of the consumer. Overall, GDP growth was 5.5%. Retail sales were up significantly in March at a 10% annualized clip. This retail sales activity was supported by another round of stimulus. Retail strength is expected to last throughout the year, and with consumers sitting on a lot of cash, 2021 consumer spending could go down as one for the record books. With that said, we see GDP growth around 9% for the second quarter, 9% for the third quarter as well, and then tapering to around 7% in the fourth quarter. A quick word on inflation. The March CPI rose 0.6% for a year-over-year rate of 2.6%. So inflation is picking up a bit. In fact, the last 3 months CPI annualized at 5% annually. The Fed is on record that it'll take a wait and see attitude. So immediate rate increases are probably unlikely. However, it is safe to say that the I word is back in the economic discussion. Quick nod to the stock market without getting too deep. The stock market was up 6.2% for the first quarter per the S&P 500. It basically has increased 80% from the March pandemic low, 80%, which is an amazing number when I think about it. As for the banking commentary or banking industry, banking sector assets or banking sector's earnings should rebound in 2021 due to loan reserve releases and some margin expansion. In fact, earnings could be up as much as 40% this year. Last year's ROA for the industry was about a 0.71%, and 2021 is estimated to be about 0.92% for the industry. There's still a large amount of liquidity in the system as a result of the PPP and stimulus programs. And however, loan demand is still weak, except for those PPP loans I just mentioned. As far as credit quality, despite the negative impact of the pandemic, credit quality has remained somewhat resilient. Loan losses are expected to peak in the mid to late 2021, but strong loan reserve levels will cushion the blow. To sum up, we have an expanding economy, which bodes well for the industry. The industry will have higher earnings, credit quality seems to be holding, and capital looks to be strong. So now let's talk about the M&A landscape with Kurt and Jason. Kurt and Jason, do you want to give us a little idea of what happened in 2020 and then take us into 2021?
Sure, thanks, Jim. So as everyone knows, 2020 was quite an eventful year, a lot going on for you as bankers, but on the M&A side, it was pretty quiet for us investment bankers as you started thinking about deals. The first quarter of last year, you saw about 41 deals, most of that in the first 2.5 months. And then once we got to about March 15th, things shut off. You only had 9 deals in the second quarter, and then things heated up a little bit with about 30 deals in the third and fourth quarter. So you only had 112 deals for 2020, when on average since 2014, we've had roughly 250 deals per year. The big reason for that slowdown is you as bankers, once March 15th hit and you all had to work remote, PPP came on the scene, everyone just had all their internal issues they had to deal with. Working remote was a new thing for most banks out there, getting their tech systems upgraded so you can have everyone work remote. And then PPP, that was a whirlwind for everyone. And then as you got into the back half of the year, credit was still a concern. Most buyers we talked to said we can't even figure out what loan losses we have in our own portfolio. We've taken a base case of the Great Recession. We've doubled it, we've halved it. And it's really a 33% shot at each of those happening. So buyers said, when we can't predict our own portfolio, how do we expect to underwrite a seller's portfolio? So things were on hold. The deals you did see happen had been in the works previously or were really bite-sized in nature, a bunch of sub 100, sub $250 million banks that sold. And then the other ones, you saw a lot more terminated deals than you had in the past. And a lot of those deals were terminated because of credit concerns, falling stock prices, and then cash deals versus stock deals, where the regulators had some more concern with capital flowing out of the system than remaining in the system through a stock deal. So all in all, last year was pretty slow on the M&A front. But now what you're starting to see is we've had about 52 deals year to date. It hasn't picked up quite to the 250 a year pace, but we are seeing increased activity. And a lot of that's caused by you had sellers that were going to sell and thinking about it late 2019, early 2020, that got put on hold. Now you also have sellers that are looking at the industry headwinds. And that's where we're going to open it up to the rest of the panelists as well, that you've got margin compression, you've got taxes, you've got regulatory pressure, you've got board fatigue, management fatigue. So all the things you had pre-pandemic coupled with built up seller demand that just got put on pause.
Kirk, I'll take it from here. The only other add-on I'll make to what happened last year is it's M&A activity usually ebbs and flows with where public banks are trading at. And as everybody on this call and all of the folks listening in remember, during the middle of the summer last year when most, if not all banks were trading at or under tangible book value, it makes it really hard to do M&A transactions when public equities are trading that depressed. Fast forward 9 months, and in many cases, there's a large amount of publicly traded banks that are at or near their all-time highs. So we would anticipate 2021 and clearly going on into 22 and past then, assuming banks continue to trade where they are, for M&A activity to rebound substantially. I'll hit on a few of the main topics we believe that will augment M&A activity outside of the fact of where banks are trading, which is clearly helpful and is going to stir up both supply and demand. But margin, like Kirk mentioned, the average community bank under $1 billion 2 years ago had a bank margin of around 3.85%. That shrunk down to about 3.35% in this last quarter. Now, some of that has to do with all the excess liquidity on the bank's balance sheets from PPP and deposit inflows. But no question, new loans are getting put on the books at or below where the current loan yields are. And that's going to continue to have some near-term pressure over the rest of this year and possibly in a part of next year. And who knows if rates will go back up in 23. We as an industry think something's going to happen. The opposite does. So let's hope for the sake of margin that we can have some stability in rates and those can end up going back up somewhat, because margin compression is going to lead to M&A consolidation. Consolidating industries like banking have always consolidated because of expenses, duplicate expenses across the board, scale. But when you factor in low margin environment, many banks are going to use M&A as a way to increase revenues, increase earnings accretion in light of continued revenue challenges from the margin side. From a cost control standpoint, I remember coming out of the last recession, the Great Recession, for the first 4 or 5 years in that downturn, as well as after, efficiency ratio was the big thing. How can we cut costs internally? How can we decrease our efficiency ratio down to levels where we can continue to grow profitable businesses? And so many banks have gone through that process. A lot of the low-hanging fruit, I think, on the expense side has been picked off over the last 4 or 5 years. Now the big topic now is, because of the pandemic, analyzing y'all's branch networks and your distribution channels to make sure that branches can be profitable. How many branches do we need in our markets? So you've seen a lot of branch consolidation, a lot of branch closures. I think that's going to be a new topic in the bank M&A side, is that branch rationalization, branch closing, maybe getting out of leases early, consolidating more branches than you would normally is going to drive additional M&A, and that could cause additional costs related to those transactions. But no question, branch consolidation, rationalization is going to be a main topic as we kind of get into the next few years. I'll touch on technology too. I remember we were at the Acquire Be Acquired conference 2 years ago, and a few months prior to then, we all heard the news with SunTrust and BB&T merging. And one of the big questions was, why do they want to get bigger? They're already $200+ billion banks. And I remember one of the main reasons why was because we can't afford the technology that's coming away. So $200 billion banks are getting together because of technology challenges. No question that's going to come downstream. And there's so many different technology add-ons that banks are being faced with today. And quite often they're very, very expensive. But during the pandemic, I think we all saw that the digital world has been accelerated. As we're on a Zoom call today, having this, who would have thought we would be doing this a few years ago? But I do believe that technology and the advancement in technology is going to accelerate in the bank space. And Kirk will talk in a few minutes about the non-bank space from a fintech standpoint and how that's disrupting the industry. But no question, technology investment is going to be a major hurdle going down the road for smaller community banks, and certainly will be one of the reasons why they look to find a larger partner.
Yeah, some of this may not be a financial issue or somewhat of a strategic issue, but I see a lot of community banks that have boards and shareholder bases that have been at this for a long time. Maybe they started the bank in the late 90s. There haven't been dividends paid, and they just went through the 2008, 2009 recession. Here we are, we're at the pandemic, we're coming out of it. And now they're sitting there, they could be at a more advanced age, they've been at this for a while, and they have to look and see, okay, are we going to stay with this? Are we going to stay in this business for the next 5, 6, 7 years? Because there's going to be a tremendous amount of changes in the banking business over the next decade. And so do we get out now, or do we saddle up and try to ride it and try to stay abreast and stay in lane with some of these other banks? And so I think I don't know if that's a demographic issue or just a vintage issue in regard to when they started the bank, but I see that also pushing the bank merger acquisition or sale and acquisition, the M&A market rather. I see that as something that I think maybe not financially, but just from a non-financial perspective, pushing deals.
Yeah, Jim, I'd agree with you there. Jason kind of touched on it on BB&T and SunTrust coming together. When you look at JP Morgan Chase, they're spending about $10 billion a year on IT tech related build out and BSA, AML, hacking that we've seen across the country. Our government has been hacked to the deepest levels. So the banking industry is exposed to technology more and more. And what a lot of people have said, and this was late last year, is you had about 10 years of advancement in technology in 10-month time frame of the pandemic.
Yeah. And
when you're seeing a JP Morgan spend $10 billion a year, no one's saying that community banks around the country have to keep up with that. But 80% of the banks in the country are less than $1 billion in assets. So how are banks going to continue to keep up with that pressure?
Right.
And that's where you're seeing that enhanced discussion of maybe we do need to partner up with someone else, or even if we're not taking chips off the table in a cash deal, let's partner up and take stock in someone else and continue to get bigger and get scale, just like our bigger brethren are.
Yeah, I mean, it's not so much the money's big, but in certain locales and things like the talent, where do you get the talent
Mhm.
to run a highly sophisticated technology operation? And, you may be in a more rural area or something like that. It really makes you think about, how far are you going to be left behind, especially as, we were talking earlier offline about what is our competition. Well, your competition's more than just geography now. It's on the internet. People can go open accounts all over the place. And so if you're left behind and there's no talent, I think you really have to look at what your strategic options might be in an M&A sense. I think it's important to at least think about it.
Yeah, and as we continue to see non-bank acquirers, whether it's a lending club or a SoFi that are looking to buy charters, have announced deals and closed deals. You've got a Vero that applied for a de novo and spent, I think, $120 million through that whole process and got approval. We worked with a wealthy family that made their money in fintech earlier this year that announced the acquisition of a bank in California. And, that is just a sign of the times that you're going to continue to see non-bank fintech type companies try and encroach on the traditional community bank. And, what you see is there was a research analyst that put out a note before saying PayPal is better than basically every bank out there. They've got a higher market cap than every bank outside of JP Morgan, and they've got a better delivery system. What do you need a community bank for when PayPal can do half of that better? I'd argue that community banks are essential, and, PayPal's got some great algorithms that the banks don't have. But in your traditional community sense, PayPal doesn't know any of the communities there. And a lot of banks do have relationship lending, whereas these fintechs bank on an algorithm.
Right.
But it's a pressure that we're seeing across the country.
Right. I agree. Absolutely.
I'll add another point to that. I remember I heard the news 3 or 4 months ago that Shopify, which is the largest sort of online store conduit that has over 1 million businesses, is now announcing Shopify Bank, so that they can cater to the needs of those online stores. And as things get to be more digitized from a marketplace perspective, there's no question that there's going to be quite a bit more disruption from the fintech world into the bank space.
Right. Well, of course, we just had the State of the Union address the other night, last night, I guess. And so, that tax increase is a big thing, right? Especially if you're sitting on a low basis and, that increase in the capital gains tax. I mean, it has to go into the formula for what you're thinking about doing, especially, again, coupled with some of those demographic issues we talked about later. Could be a great time to go. If you don't have a strategy for the next 10 years.
Yeah, and that's a good point as well. I mean, what you're seeing on the capital gains side is a proposal to bring it up for the top end to 43.4%, which is higher than it's been in the last 50 years. Treating it as ordinary income, but worse because you still have the Obamacare 3.8% tax added on top of it. So the problem, and this is a conversation that's happening across the country. We've got multiple clients that just in the last 2 months, we've signed up and we're going to be taking to market in the next few weeks. And these are probably the last clients you're going to see that are going to be able to get a transaction done this year. If they're wanting cash and trying to lock in their gain this year with not knowing where it's going to go next year. Your typical transaction from start to finish, from deciding to go to market or deciding to sell, is going to take 6 to 9 months. So those sellers that are thinking about this now, and if they make a decision in May or June at their board meetings to sell, it's unlikely they're going to get that deal closed this year. So then they're at risk of capital gains going up next year.
Right.
That said, we still have a lot of clients that are saying we want to get something done this year, but we want to take stock and we want to have a little more optionality, because if we want to sell out of that stock, we can, or if we want to take a few chips off the table, and then look, we'll ride it. And if Biden doesn't get reelected and a Republican gets elected in 2024, it's likely things will swing back the other way. So
Sure.
there is going to be a rush in some sense, and then you're going to have another group that takes a wait and see approach of how quick does it go up, and do we just do a transaction that is a tax-free reorganization, and we will ultimately lock in our gains once a new administration comes into office.
So all these are drivers. What does the panel think about the obstacles? We kind of touched on a few, but what other obstacles are there to M&A flourishing in 2021?
Well, I think it'd be great to hear from the Waller guys here, from what they're seeing on the regulatory side with the Fed and the different regulators on how they're reviewing, especially with the new administration in office.
Yeah, this is Richard Hills. I think the initial takeaway, and given that we're only not a little over 3 months into the new administration, but the key takeaway at this point is, and I'll get into some of the specific factors that buyers and sellers need to focus on from a regulatory perspective, but deals will take longer to complete. So when you said, from deciding to sell to closing, what would typically be a 6 to 9 month process, I would say, especially for larger transactions, that you're probably looking at 9 months to 12 months. And that's mainly because, and this is specifically true at the Federal Reserve, that the reserve banks are not acting under delegated authority, and Washington is seeking to do its independent analysis of transactions. And obviously, as we all know, everybody wants to keep their transaction under delegated authority, whether it's in Atlanta or St. Louis or whatever the applicable reserve bank is. But under the new administration, the Fed is even if it's still under delegated authority, the applications are getting feedback from DC. So I think a challenge will be, a rush to get deals done this year will be, we will give advice on how to position, especially for acquirers, how to position yourselves to get deals done quickly.
Richard, do you see the process remaining the same? Do you see any additional stages in the process, or just a lengthier process?
Well, I think for now, the processes are going to be the same. I mean, we have not had a change in the application. We haven't had a change in the Bank Merger Act as far as the criteria that are supposed to be reviewed. But however, as part of that, there is one of the areas that has to be reviewed is convenience and needs. And you can and regulators can pack a lot into convenience and needs, including fair lending and CRA compliance. And as we all know, there is rumbling of a significant changes to the Community Reinvestment Act. Of course, the OCC tried to do that last year on its own. That got put on hold. But I think there is going to be some changes in the Community Reinvestment Act and how that will impact merger transactions, especially obviously for institutions that have an unsatisfactory or need to improve rating. They may be in the penalty box anyway, but if they want to, or they have a 3 or lower compliance rating, they may be in the penalty box. And there are ways to get out of the penalty box prior to a full compliance update. But obviously, I mean, compliance, CRA, fair lending, and the lack of delegated authority will all combine, I think, to maybe slow the process down where you used to have streamlined Fed waivers. If you had a bank merger at the same time as a holding company acquisition, the Fed would waive their application requirements and defer to the bank regulator. I think we'll see less of that as deal activity picks up, and that's certainly going to be the case on the larger transactions.
Yeah. Can we talk a little bit about, in terms of an obstacle, valuation?
Yep.
Certainly there are, I looked at some of the numbers, and of course, from the beginning of the COVID modification experience, the numbers have gone way down when you look at, in terms of compared to capital. But there's still banks out there that have COVID mods and things like that, or have assets in industries that are more susceptible to that. Is that going to be a big major issue going forward in terms of valuation this year?
Yeah, I mean, I think without a doubt that we've had a nice stimulus Band-Aid put on the economy for quite some time, and with $10+ trillion getting put in the system, a lot of challenges can certainly be hidden. And I do believe in many of those asset classes, there is going to be a heightened level of due diligence from a credit perspective. The last thing any bank wants to do is undervalue a loan portfolio because it looks good on paper today, and have those come back and bite you a few years down the road by having to charge off a lot of those loans. That's a recipe for disaster from a buyer's perspective. So there's going to be more a heightened awareness, I believe, into the loan books of many companies, just given where we are. Hopefully it doesn't happen, but there could be a little bit of a hangover next year when the stimulus dries up, all the programs, are finalized. And a bank is going to certainly do its due diligence into that, make sure it underwrites it properly. From a valuation standpoint, banks are typically valued on earnings. And as everybody knows, last year was a year of one-time events, right? We had kind of Q2 where there were a lot of provision increases, oftentimes no earnings. All the earnings were getting put into provision in anticipation of what may or may not happen in the pandemic. And then that was somewhat neutralized by PPP, which has been a huge opportunity for banks to fund their loan loss reserves in anticipation of what's going to happen. So it reminds me back in the day when SBLF came off. SBLF was somewhat of a gift during the last downturn, and PPP was kind of our gift to the industry this time.
Right.
But most of all of our clients have come back and said, yeah, we had a record year last year. And without a doubt, PPP helped. Low interest rate environment has made last year probably the best mortgage origination year on record. And buyers are going to be cognizant of whether or not those trends can continue, specifically on the mortgage revenue side. So mortgage revenues are typically valued about half of what bank earnings are. And it's going to be a challenging comp over the next 2 or 3 years for banks to be able to maintain those heightened levels of originations. So buyers are going to really dig deep and figure out kind of what the core run rates are at a bank, which is likely going to be a little bit different than what's shown on paper today. And that will create a little bit of a bid and the ask, if you will, on how to value that earnings stream. So as time goes on and things somewhat normalize away from the pandemic, and a lot of these one-time events will be a little bit easier to kind of value that earnings stream. But right now, there'll be quite a bit of additional diligence from that perspective.
So Jason, what you're saying is buyers' expectations and sellers' expectations are probably going to have a gap for a while until all of this kind of settles out a little bit, and then that expectation will kind of clear up a little bit and get a little more a little closer.
It will, but one thing that can help to mask that are public buyers continuing to trade at near-term highs, right? Yeah. High valuations can help to bridge that bid and ask much easier than when buyers are trading at 20 or 30% less than they are today. Right. But we expect to see some pretty sporty M&A transactions get announced here over the next number of months, and oftentimes that creates a perception that my bank is now worth 50% more, this quarter than what it was 2 quarters ago.
Right.
And we would just make sure everybody, you understands each transaction is different. And each transaction has a different set of buyers who may trade at different premiums. So each opportunity will be viewed, somewhat in sort of a box, if you will, going forward.
Yeah.
Yeah, Jim, and to expand on that, a lot of the deals you've seen so far, you've had a lot more headline deals where, multi-billion-dollar banks coming together, 20+ billion-dollar banks. You got a Huntington, TCF, you've had a few up in the Northeast, Mid-Atlantic. Those are public buyers and sellers. So whether the seller agrees with their stock price or not, it's a pretty good metric as to what their value is, because that's what the broader market's ascribing to it. Whereas with a lot of the smaller private banks, their expectations are higher than where the buyers are willing to pay, because you think about it, they had record earnings last year or near record earnings, credit quality. You talk to any bank out there, and for the most part, they don't see any problems in their portfolio. Do they think there might be a few credits here or there that tip? Yeah, but they're saying these were credits that were kind of on the bubble pre-pandemic, and so maybe the pandemic pushed them over the edge. But if I don't have credit issues in my portfolio, if I'm having record earnings, why should I sell for a discount to where I would have sold in 2019, 2018? So I do think there is going to be a gap for a little bit of time. On the credit side, you look at a median credit mark right now, even with the pandemic, has been roughly 2%. So a 2% mark on your loan portfolio, which you had a few deals. There was one in Illinois that had a 4% mark, but there have been some in the mid 1%. So it really hasn't been much different on the credit side. And that's giving these sellers pause and saying, well, why should I accept a 130, 120, 140 of tangible book when pre-pandemic I probably could have gotten 160, 170 of tangible book.
Kirk,
I have to admit, I'm surprised that we haven't had more credit issues. And I know I still feel there's some embedded in the system, especially when you see banks, some banks, the modifications ramped up and they came down real hard, and they're basically almost out of it, in terms of their exposure to that. And then there's some banks there that ramped up, came down to a level, and that level's sticky. So if I'm looking at a portfolio, I'm seeing the stickiness of that number, of those PPP or their COVID modification numbers. I think it's
I think
problematic.
I think one thing to think about is back in the Great Recession, credit, things hit the fan. Credit went south quick, and I will give it to the government. I'm usually not a big fan of the government over here, but I'll give it to the government. With PPP, it was essentially a backdoor way to inject capital into banks, different than TARP that had a lot of negative PR to the general public. No one's talking about PPP and how it benefited banks and basically positioned them. But I think all in all, the Fed and the government traded asset quality issues for interest rate pressure on banks. And so you're not going to see heavy asset quality issues. And again, you'll have some pop up, but that's where I think you'll start to see values come back. Buyers and sellers valuation, the gap somewhat disappear, because once PPP disappears, once mortgage banking slows down, and we get into, a few more quarters, back half of 2021 into 2022, you're going to start seeing some of these real pressures that are on the bank space, lower interest rates, NIM compression, organic growth is very hard. Hopefully it picks back up, the economy picks back up, but a lot of banks out there are saying, once my PPP runs off, I on a core basis might be shrinking, because you've got so many banks are flush with liquidity, but customers are flush as well, and they're paying off their loans.
Yeah, and some of the opportunities on the lending side are in the real estate world, and community banks always have concentrations in that, and so there's pressure that's going to come from the regulators because you've got too much real estate concentration. So it has a tendency to kind of go round and round in that regard.
Hey, Jim, I was going to hit on one last point if I could. I know we got to move on, but I think if you're a smaller bank looking to partner up with a publicly traded company that has a high valuation, I think the biggest difference between where we are today versus prior cycles is there are just fewer publicly traded buyers that I would consider to be upstream partners today. In many markets, specifically Georgia, we used to be able to sell a $500 million bank and get 12, 13 publicly traded buyers to bid on our company. I can probably count in many markets where that could be down to even 2 or 3. And that means, I think, from a timing perspective, knowing who those parties are, making sure that you know them right now, and being flexible on when you may be willing to have that conversation based on when they're open and available to transact, because they're going to have a long pipeline of other banks calling them up and possibly wanting to transact with them. So I would encourage everybody out there to know who those upstream partners are, be flexible on timing, have the timing be almost equally as weighted about when are they available and open to do a transaction. If there's reciprocal interest, and perhaps that means that the timing has to be accelerated, that's where I think there's going to be a major change in where we are today versus in prior cycles.
Yeah, that's a smart comment. We've talked about drivers, obstacles. Kirk, buyers and sellers, what are they looking for? We might have touched on a little bit of this, but the way I look at it, you have a universe of buyers, you have a universe of sellers. Hovde Group's job, I guess, is to bring those universes together, right? And make a match. What are the most important issues that a buyer would have on their wish list?
Yeah, so one of the big things that's always out there and has always been out there is talent. It's tough to find quality talent in today's market. You've got a ton of people that aren't going back to work because of unemployment checks that they're getting. You've got a bunch of bankers that have been retiring, especially the customer facing on the lending side.
Yeah.
Buyers are looking for quality lenders, quality management that can help fill in some of the gap. On tech, we talked about it earlier. You get a lot of people that don't have the tech wherewithal, and so they're looking to find talent, get bigger so that they can bring in people who understand that space.
Right. I think that's your comment in regard to talent is spot on. One of the things that I've noticed, I've been in the community banking space for a lot of years, and so there used to be a natural feed. The big banks had training programs. People would go to those big banks for whatever reason. They didn't want to be at a big bank, and those big training programs would feed the community banks, and you'd get a lot of talent, and it was good. And of course, that all stopped maybe 15, 20 years ago. I don't know who's running a good training program now like they did in the old days. And so when I look at community banks that are, say, on a smaller side, 500 million below, maybe 700 million below, there's a big drain in terms of youth. There's no young people coming up, especially on the lending side. I believe, we're competing against other industries, and we've got to be sexier. I mean, if you have a young person that comes out of the University of Tennessee, which I went to, by the way, greatest school in the world, you go to Tennessee and you're a real smart person, you're tech savvy, do you want to be a banker? I mean, that's the thing. We're not getting those people. And I think the talent issue is a very big problem in the community bank space, especially the smaller end of that. So your talent comment is spot on.
Yeah. Aside from that, growth markets, be able to expand into attractive markets, whether it's bolster your existing presence or enter new markets. This kind of touches on Jason's point previously, but you take Bancorp South and Cadence that just came together. A lot of Bancorp South's legacy markets were slower, no growth markets. Cadence had some presence in Texas and Florida, so you get to expand into higher growth markets. Right. But that also then goes to the fact of, and the Waller guys know well, I mean, Bancorp South used to buy $250 to $1 billion banks and do 3 to 4 of them a year. Now they're going to be a 45 billion plus pro forma company. They're not going to look at those same targets. So, for buyers right now, and it kind of touches on the regulatory side too, with the enhanced timing and things you have to go through, people are starting to say, we want a little more scale when we're doing something, because it just moves the needle a lot more in many different aspects than historically going and looking at that smaller bank and doing a number of them at a time.
So let's flip the coin. We talked buyers. What about sellers? We've touched on some of these things, but what is your opinion on the top most important things that sellers are looking for on their wish list?
Well, it sounds corny, but it's price. For the most time, price is first and foremost, but it's going to vary with every single client. You've got to figure out, on the closely held banks, a lot of it is, hey, we just want to lock in our price and walk away from this because we've got estate planning. You're going to have one of the biggest generational transfers of wealth. And when you look at a lot of these closely held or community banks that have been, even if they're not closely held, have been in existence for 80, 100 years, a lot of the shareholders that will be receiving the stock through a will, estate planning, don't live anywhere near that community bank. And so they're just going to sell. So from a seller's perspective, it's price, but then culture. You see with a lot of community banks that price is important to them, but their people, their customers are very important as well. And so they're going to look for a buyer that they think the culture fits, that will take care of their customers and their people. All sellers understand there's going to be efficiencies throughout a transaction and that some of their customers and their employees will be dislocated. But culture is a huge thing that we hear from a lot of sellers. And when they're analyzing, who should we be reaching out to?
Right. I think you're right. So let's change gears a little bit and let's bring Richard in. Richard, how are the banking regulators going to approach M&A in 2021? Can you give us some insight into that?
I will do my best. I would like to say that, I appreciate your reference to Tennessee as being the second best school in the Southeast behind University of Georgia. I appreciate that. Having said that, I think there are a lot of unknowns as we head in. Obviously, the Biden administration has several priorities that they want implemented throughout the administration. The first we've talked about a little bit, and it's convenience and needs. And the one that I can guarantee you, that will be reviewed as part of a merger transaction will be diversity, as we've all heard about it. And just so I can just to make sure that everyone is aware of how important this is. Maxine Waters, who's now, of course, the chairman of the House Financial Services Committee, she said that, quote, regulators must also evaluate whether the banks are making diversity and inclusion an intentional priority, and they must rigorously review whether the proposed merger truly satisfies all relevant requirements and creates a public benefit. The practice of regulators rubber stamping bank merger applications must stop. Now, I think those of us who have dealt with regulators for many years would argue that regulators have not rubber stamped applications. Now, most of them do get approved, but there is a lot. There's a lot that goes on between submission of an application and getting your approval. And one of those things will be the board's, the surviving bank's board makeup, and whether it will be diverse, especially for larger banks, much like the NASDAQ rule that was issued, I think it was late last year, on having a diversified board or disclosing why you're not diverse. I think it's not a traditional element of the bank merger review process, but regulators get to do a lot in reviewing a merger application, and I think diversity and inclusion will without a doubt be an issue that is raised for purchasers, and especially larger purchasers. And for purchasers that are already over 10 billion and have the luxury of being supervised by the CFPB, we certainly have a much more aggressive CFPB coming into power. And so fair lending again and compliance are going to be key. And don't forget, one of the areas that the CFPB, they have issued some proposed, I guess, guidance questions, but one of the areas they want to focus on is disparate impact, and which, is, just to clarify what we're talking about, is it's a neutral policy on its face that causes a disproportionate impact on a prohibited basis that's not supported by a legitimate business policy. So we've seen a lot of that, redlining, that you may not have intentionally done it, but it results in de facto redlining. And also the CFPB is expanding the scope of protected classes to include non-English speakers, the LGBTQ community as well. And so there is going to be an increased focus on diversity. Also,
Richard, one quick question on that. I've actually heard
Sure.
this from a number of clients. And are you seeing on the diversity push, especially amongst boards, is that more at the public size, the SEC filing, NASDAQ, New York Stock Exchange listed, or are you seeing it with the private banks as well? And then on top of that, as a second question, as we know, there's metro markets are more diverse than rural markets. And there's markets around the country where I've heard clients say, we don't know how. We're not opposed to making our board diverse. We just don't have necessary talent in this space. And so how do you go and attract that in order to appease the regulators?
I think you're certainly right. It started with the large public banks, specifically NASDAQ traded, but it has filtered down to other public banks, and it will filter down to the community bank. And this is something for you may have sellers that are, you're right, in a small town, you don't have the same diverse population that you might have in a Nashville, Atlanta, New York, Chicago, and there are acceptable explanations for that, but the buzzword is diversify or explain, and it might drive some sellers to sell in a situation where they might not otherwise want to, depending upon how aggressive the regulators are on the smaller banks to diversify their board and management ranks. But we have seen private banks that have, like you said, they want to diversify their board, but are having a hard time filling those, finding suitable candidates right now. I think the other great unknown, but certainly something that will be evaluated, is, and we don't know exactly how this is going to look yet, but climate change is a very top priority, especially Secretary Yellen. The Federal Reserve Bank of San Francisco has been a big proponent of even having larger banks, stress test their loan portfolios for climate change. I don't know how you do that. And I don't think any banks know how to do that yet, but that is something that will be, whether it will be immediately implemented or whether we're waiting for additional guidance on, and that we're not talking, and this is, banks portfolio. And, obviously there's been some discussion about banks lending to, gas companies in Texas, for example, and the OCC coming out saying you cannot, blacklist an entire industry just because it may increase climate risk. So we'll have to see, how that plays out. And then one final point on the maybe positive is, as we were discussing earlier offline, the bank merger review process from an antitrust perspective is, I think everybody would agree, is outdated. It hasn't been changed in my career, which is 25 years. And so there are guidelines out there for the bank merger review process to take under advise, to also consider non-bank players in the space, including non-bank lenders and fintechs. And that, a good example is, if I can't get if my local bank is going to charge me 6% for a mortgage, and I can get online and get that for 4%, the competitive analysis based on the market share of deposits is not an accurate reflection of the competitiveness in the market. But right now, it's a statutory factor that they have to review. I personally hope they will change it, because I do think it will help smaller banks sell in what would otherwise be an anti-competitive transaction.
Very good. Thanks, Richard. We have about 10 minutes left, so I want to throw this over to Wes, and hopefully, and maybe Kirk and Jason can jump into this as well. We want to talk a little bit about the capital markets outlook with the time we have left. Wes, can you give us a little insight?
Sure. I would say, just looking back for the last 2 years, 2019 coming forward, for a reasonable look back period, the market's been either hot or at worst healthy. And there's been good, solid appetite, primarily for debt instruments from my vantage point, primarily the subordinated flavor. Preferreds are still out there. It's a viable option. And recently we've seen common coming back around. I believe Congressional just raised $345 million last month or so. So the market has been hot. I think a lot of people at this point have topped off or maybe satiated their needs, clearly in response to COVID, as a rainy day fund, potentially. Back in 19, moving into 20, as a pandemic was coming on, clearly as a Band-Aid for potential credit issues. But as we've talked about on this panel, those haven't cropped up quite like everyone thought initially. Other reasons, dry powder for M&A, maybe even refinancing your debt to a lower rate. So for all those reasons, a lot of market activity, a lot of people have hit the market, a lot of people have topped off at this point. I think, however, from at least my perspective, there's still a steady rhythm and a steady cadence still going on out there. Deals still cross the desk weekly, still see the announcements. We've had a fairly steady rhythm in our practice as well. And with our peer set of our clients, they seem also as well to be fairly active in those markets, not near to the pace as what we saw earlier in late 19, early 20 pre-pandemic, and even into the summer and fall 20. So I don't think it's going to keep at that pace, but I still think there's healthy demand out there in the marketplace. On the flip side of the coin, I think, honestly, there's so much liquidity, though, in the marketplace. Banks are having trouble deploying the capital they've raised, and so they're looking at how to do that and put their money to work. And so I think you're seeing share buyback programs starting to kick back up, kick in place, banks buying into that concept again. Early in the pandemic, it seemed as though it was not in vogue or politically unacceptable to be doing that. And so people shut them down or tapered them off significantly. It seems like those are kind of regaining traction at the moment. Powder now being used and looked at least, as for much of this panel is discussed, potential M&A activity going forward into the future. What can we do with it? Looking out there, who can we spend it on? Checking out prospects with that capital sitting on the bench. Also, quite a bit of talk on earnings calls that I'm hearing, at least, of plowing that money back into the organization, building the franchise, technology, infrastructure growth to combat or to deal with technology issues as they're coming more and more to the fore. So we've had a pretty torrid pace all in all last 2 years or so. I think we'll keep a pretty steady rhythm going forward. And so I think the markets will remain open at this time.
Kurt?
Yeah, Jim, to expand on that quickly, as Wes said, going into last year, you had people, or prior to last year, you had a lot of people looking at common equity still. Then the pandemic hit, you had banks pause. No one was issuing common because you had some banks trading down in the 40% tangible book. Subordinated debt became the mainstream item that was being issued because it was cheap. Right now, a lot of banks are issuing subordinated debt for 4%, give or take, 50 basis points. And it's a very cheap form of capital. Even if you're getting in the mid fours, it's still cheap from historic levels. And so banks are utilizing that. You have banks issuing subordinated debt to do a stock repurchase because they're saying we'd rather use up our cheaper form of capital and subordinated debt than using common equity to repurchase our own shares. And Wes touched on it too, on the common equity side, or just on the equity side. You've seen some preferred offerings out there. A lot of those are, $10+ billion banks doing $100+ million preferred issuance, in the 5 to 6% coupon. There's some smaller, but that's typically bigger banks looking to do that. But then on the common equity side, a lot of banks are bloated right now. They don't understand where their balance sheet's going to turn out as PPP starts to be forgiven, do deposits start to run out. So they're hesitant to go raise a bunch of equity just to boost their leverage ratio if they do shrink. And then they don't have anything to do with it in a lot of these cases. And Wes hit on it perfectly. We've had plenty of clients say, hey, we're trading at great values. We would consider raising equity now. We don't have a need for it. So if we get a deal where a seller wants some cash as part of it and we need to raise equity, sure, we'll pull the trigger. But what's the sense of going and raising 20, 30, 50, 100 million just to sit on it?
Great. Jason, any comments from you on this topic? Or
No, I think that for this group on the call today, I still think subordinated notes will be an option for the rest of this year. Typical buyers of that product have been other community banks who are in loan growth markets that are challenging and using this as a way to put some liquidity to work. And we have more and more banks asking us for product every day, although every time you see a deal that gets announced, a lot of that capacity will end up being reduced as a lot of the buyers can allocate, a certain percentage of their capital to this instrument. And when they're full, they're full. I still believe it'll be a pretty active environment and an attractive one for small banks to raise tier 2 common at the holding company and downstream it as equity throughout the rest of this year. But as everybody knows, and we hope this isn't going to happen, but if there's ever a glimpse into some credit deterioration, that product will dry up, very quickly.
right.
So subordinated notes is the primary and cheapest form of capital. Common equity, if you're private, you better have a way to put it to work because you're probably going to be going after private equity investors who are going to be asking you to do things like be on your board, be an advisor to the board and want registration rights and all sorts of stipulations. If you're public and you're trading at a good valuation, clearly it's better when all the other banks are trading up. Those deals can get done today. But like Kirk and Wes mentioned, what are we going to do with the money? So use of proceeds is obviously number one in terms of what any equity investor is going to ask when they put money in the bank.
Right. Well put. Well, we're about out of time. We have a number of questions, but we won't be able to get to them. But I encourage everybody to reach out to any of the panelists here directly. We'd be happy to answer those questions offline. So on behalf of all our speakers, Wes, Richard, Kirk, and Jason, thank you for joining us today. We hope you found the seminar, or the webinar rather, beneficial as you consider the issue of M&A over the next several months next year. So thank you very much, and we'll see you down the road.
Thank you, Jim.
Thanks, everybody.
Thanks, Jim. Thanks, everyone.